Good morning, everyone, and welcome to our webinar today. We'll provide an outlook on year-end tax planning based upon the outcome of the election. And well, here we are, 3 days post-election with a presidency that's still undecided. So today we'll discuss both parties' tax proposals and give recommendations for each. My name is Stacy Dreyer, and I'm the Marketing Director for James Moore & Company, and I'll be your host for today. Our presenters today are Suzanne Forbes and Erin Spiwak. Suzanne Forbes is the managing partner of James Moore & Company and has more than 30 years of experience providing accounting, tax, and business consulting services to clients in a broad range of industries. Erin Spiwak is a partner with James Moore with nearly 20 years of experience in the accounting industry. And in addition to her work helping clients with tax planning and consulting, she also oversees the firm's wealth management practice. All right, so with that, I'm going to turn it over to you, Erin and Suzanne, to give us an overview of tax planning strategies that we should consider before year end.
Thank you, Stacy. We appreciate it. So who won? That is the big question. I mean, I'll say that, I've been checking it every couple hours since Tuesday night. I woke up in the middle of the night, Tuesday night, expecting to see who won. I don't know why in the middle of the night. And today, it still looks like Biden has the lead and he just needs one more state to win. Now, of course, this is, considering that Trump is already started contesting and filing lawsuits in different states. So there is the possibility that if Biden gets the electoral votes, that we could not find out for sure for a couple of months unless someone decides to concede. Or if the tides turn and Trump wins all the states that are still in contest, then he would be president. The other really big question was what was going to happen in the House and in the Senate? Because even though, depending on if Biden or Trump won the presidency, the laws come out of the Congress and the Senate. So it's really important in who controls those and what's controlling the tax law. As of right now, the Congress, which was expected, has retained Democratic majority. All those haven't been settled out, but I don't think anybody thinks the Senate, the Republicans have taken over the Congress. Interestingly, they do think that because some Republicans won more Democratic seats than expected, that House Speaker Pelosi may not be reelected. So that will be an interesting turn of events to see if that actually comes true. The Senate, still tied. We still don't know. And there's actually a runoff in January between, for the Georgia Senate race between a Democrat and Republican. So we may not know confirmatively until then which party is controlling the Senate. And honestly, if it all is a Democratic House, Senate, and presidency, as you will talk about, we're likely to see tax law changes. If the Senate retains Republican majority, then we're likely going to still have more of a stalemate potentially, or possibly have to have a lot more, I'll call it horse trading, to get the Republicans, one or two Republicans to vote to the Democratic side to change some laws. So Suzanne, let's talk about what does this mean when we talk about tax law changes?
Sure. So I actually have to go back to my history lesson that I learned in civics somewhere. So let's talk just for a minute about the tax law changes and how they happen. Typically, they come out of the Ways and Means. They would normally go to the House. They would approve, and it would go to the Senate. The Senate would approve, and it would go to the president to be signed. That doesn't always happen. Sometimes it goes back and forth. It can come out of the Finance Committee. So what we do know is that it would have to be signed if we have a Democratic House and a Republican Senate. It's going to be harder to get laws passed. For example, when Trump had in 2016 and when he was inaugurated in 17, the Republicans controlled the House, the Senate, and the White House, and it almost still took a year to get laws changed. The laws didn't actually get changed until December 2017. So that gives you an idea of when you have control, when one party controls all of them, that it could take almost up to a year. So what we don't know at this point is, obviously what happens with the Senate. We're not going to know that. This sounds like till January. And then if it does, let's say you had all three parties were Democrat. The Democrats took over the Senate, the House, and the White House. It would still take some time for those laws to get passed. Now, what I like to tell everybody is even once we get a law passed, so the Congress and the president signs off on a law, then those laws go to the Treasury, the IRS, and they write regulations to interpret those laws. Now, if it's a simple rate change or a bracket change, that's not a big issue. But for example, when we had in 2017, when they came out with this qualified business income deduction, known as a 20% pass-through. It was more than 1,000 pages of regulations for 1 page of law. I mean, it was just horrendous, the amount of regulations that came out. Then the next step after we get regulations is then the IRS comes out with forms, and we look at them and we get now a deeper interpretation. And then, of course, as professionals, we try to apply the forms and the law and the regulations, but ultimately it can end up in tax court. So this is a long, so what this means is I think we're still in for a lot of uncertainty for the next year.
I agree. There's definitely a lot of uncertainty, and it's a good history lesson on the tax law, because I think one of the misnomers that's out there is that, especially if Biden wins and the Democrats do have control of the House and Senate, is the tax law changes like the day he gets in the presidency. And that's not the case at all. It takes a long time and a lot of going back and forth to put things in there, because there is they have to have some sort of equalization a lot of times in the tax laws of enough revenue raised with tax cuts, if that's the case. But we have seen tax acts passed before that actually have straight revenue raisers, where we increase tax rates, decrease brackets, take away deductions, anything like that. Stacey, do we have any questions yet?
We don't have questions yet, but I think we're going to launch our next poll.
Okay. Do you think Republicans will retain control of the Senate?
All right, I'm going to close this out and share the responses.
Yes. Wow. 90%. If they do, it definitely will be a slim margin.
And there's still a big possibility, even if the Republicans do retain the Senate, that it only would take 1 or 2 senators to flip to agree with it. There might be some bargaining that goes on for something that that the Senate wants in exchange for some of these tax proposals.
Oh yeah, for sure. So some of the biggest concerns that people have expressed to us and that we've seen throughout all the practitioners is, if there's going to be a tax law change, what are we concerned with? The first one is the estate tax. So I kind of want to remind people that the IRS and the Treasury operate under 2 tax systems. One is income tax. That is one that everybody pays, right? So that one is no question, you earn it, you pay tax on it, right? The estate tax, also known as the inheritance tax, is a transfer tax. So basically that's the tax assessed when something happens and someone passes on, and they have enough wealth in their estate that there's an additional tax paid. A part of that is a gift tax, which is when you gift something during your lifetime to someone. One of the big misnomers is that when you gift something to someone, that person who gets the gift pays tax on it. But it's actually untrue. It's the transferor who would pay tax on it. So that's one of the big questions is what's going to happen with the estate tax. The state and local tax deduction, which honestly, for those of us in Florida, wasn't a huge impact when the 2017 law was passed that was enacted in 2018. This state and local tax deduction currently is capped at $10,000, and that includes real estate taxes on your personal or second residences. So even if you pay $20,000, $30,000, $40,000, $50,000 in real estate taxes, the total amount that you're allowed to deduct is $10,000. This was a much bigger impact in all the states that have state income tax, because it actually limited those taxpayers who are paying state income tax. They used to be able to deduct all of that as an itemized deduction, and that also got capped at $10,000. And then income tax rate changes. That's the one that has been in the news largely, in saying that income tax rates are going to go up if the Democrats get control of the Congress, Senate, and the White House. So questions is, why is this important, Suzanne? What is this? How quickly should people be prepared to react?
So I think that you have to act now to at least know what your situation is and how it might impact you. It depends on what your income level is. It depends on whether you have a pending large transaction, possibly a sale or anything like that. I think those are areas where you definitely want to meet with your CPA, your financial advisor, look at your state plans. Some of it depends on how much risk you're willing to take, because of the uncertainty. And and generally the economy, the stock market, businesses, all of that, they don't like uncertainty because you can't plan. And that's where we are right now. We have a lot of uncertainty. So it really depends on your risk factor as to how much uncertainty you're willing to take on. And you need to maybe know, where are my risk areas? Where are areas that I can do something about, that maybe if I make a decision now, I'll be sheltered from a future tax? Or if or should I wait and take the gamble that I'm okay for the next year? Because sitting here today and possibly before the end of the year, we may not know for certainty what you need to do, but at least you need to know what my options are. I think that's where we're at right now. We're talking about options with people. These are the options. These are the things that you can control, and these are the things that you can't control. And we're going to talk about more of these things as we go through this presentation, so you can take notes on them and see how they impact you.
So what kind of action should they take, Suzanne? Like, who would they want to meet with?
Well, I think, obviously, we're meeting with clients, with our clients, meet with your CPA to talk about, what things are going to be impacted. As a team, we may meet with our client, with their attorney, to look at their estate plan, their wealth management, to look at, what assets they have and what income is coming in. Do they have the option, for example, with retirement accounts, should they be drawing money out now, or should they wait? What are their income levels? So it's typically a team. I don't like to operate in isolation, because you don't necessarily see everything that's going on that somebody else might know something about. So I highly, of course, I can tell you the last week I've talked to clients. I got meetings scheduled next week already to go meet with clients to talk about. I talked to one yesterday who I think is on the webinar, and I said, well, we're going to talk about it tomorrow, but we don't know exactly. So much of it is, how much risk are you willing to take? If you want certainty, then we know what's going to happen in 2020. We don't. I think I'm about 99.9% sure that nothing will happen in 2020. So keep that in mind, that if you want certainty, the best thing you can do is, we know what's going to happen in 2020. What's going to happen in 21 is still up for grabs.
For sure.
So before we move on, we have had a couple questions come in.
Okay.
Could they change the law in late 2021 and make it effective January 1st, 2021?
That's a big question a lot of people have asked, and it's funny, before this election happened, I was like, I don't know what people are talking about. In my 20 years, this has never happened. If they ever changed the tax rate, it always was for the better, going going forward. Or if it was going to be worse, it was always going forward. So it caused me to actually do a little bit of research and discover that, yeah, income tax rate changes have been retroactive. The last one, I believe, was in 1993 when Clinton was president, and the Democrats controlled the House and the Senate. They actually made an income tax increase, and that was retroactive. The other ones have been like 1986, 1980, 1976. So although it's certainly not out of the realm, it has happened in the history, it hasn't happened in recent history. But that is one of the biggest concerns people have, is that if I don't act before the end of 2020, and I wait and do something in 2021, what if they pass the law that increases my tax rate on something that I thought was going to be, I'll talk about this in a minute, a capital gain rate of 20%, and now it's going to be 43.4. It's a big deal. So yes, it has happened before.
I was just going to add to that what I've told people too is, you have to remember, whoever's president next year, we're coming out of a pandemic. We've got a very fragile economy. And I don't think either president, either Biden or Trump, would want to, really sink the economy, because they need it to come back to support, their ideas and their platforms. And so, I'm maybe, an optimist in thinking that it would be gradual, that it wouldn't be instant, because I just think our economy, I don't see this pandemic being over immediately, and it's still going to be going on, and we're still going to have to, keep business going, work on the GNP and all of these, unemployment and things. And I think if you start seeing drastic tax rate changes and increases immediately, that could be counter to economic stability.
That's a good point.
So we did have one other question come in. Do you think it's safe to assume that 2021 tax laws will be similar to what they are now?
Nothing safe. I think there will be a better chance if the Senate, if the Republicans retain the Senate, and 90% of our poll people think that that's the case. And of course now we know that January. So I think that if that happens, will be more work. And again, it took Trump a year to get his laws changed when the Republicans controlled all three. So I wouldn't guarantee, and I joke that my crystal ball broke a long time ago and I have a magic 8-ball. And if anybody's ever shook a magic 8-ball and you shake it and it says, our tax rate's going to change in 2021, it says it's a maybe possibility. It's not going to give us a yes or no answer. So, but I do think, especially if the Senate if the Republicans retain the Senate, that we won't see anything drastic for 21. And along with the economic impacts.
No, I agree. And I think I go back to your comment, Suzanne, that said, if they made it retroactive, it could have severe economic issues. But we don't know. And we don't know because as you can see here, we kind of put together what Trump's position is and what Biden's position is. And just to let you know, these do not include all of their tax policy, either changes. We tried to make it specific to what the audience would be looking at here. So at a very high level, the one that's been talked about a lot in the individual income tax provision on Biden's side has been increasing top individual tax rates. So they went down to 37% in 2018, and that he's talked about increasing them back over to 39.6% for anybody making over $400,000. Again, these are this is his tax policy. So this all has to still then go to Congress and Senate, negotiate, put laws together, pass them, and all that kind of stuff. But this is what his position has been. The other big change we talked about was the itemized deductions. So currently, you have limited itemized deductions. So you don't get to deduct as many things as you did before 2018, but you get to deduct almost all of them. The only one that has a percentage cap on it is charitable contributions. And I meant to look this up before the presentation, but I think it was 65% of your adjusted gross income could be, of your charitable contributions could be deducted, which is a really large number. I think the CARES Act kind of changed that to be even increaser. So one of his rate changes here is to start limiting the amount of itemized deductions that people who make over $400,000 are allowed to take. And that reference to P's was a P's limitation that had previously been in place, where basically if your income was too high, you weren't getting a big benefit on itemized deductions. He's talked about phasing out the 199A deduction completely if you make over $400,000, which was a huge boom for pass-through taxpayers who have S corps or partnerships, that they were able to deduct 20% of their income, subject to 1,000 pages of regulations that Suzanne had talked about before. But he's talked about just taking that completely away. A big one for real estate is taking away the like-kind exchange provisions for those who have income over $400,000. That's a huge one. A lot of like-kind exchanges, I mean, people are selling things not for $50,000 and doing a like-kind exchange. These are hundreds of thousands, if not millions of dollars, and talk about removing that benefit. And then increasing tax credits for families. And remember, a tax credit's better than a deduction because a tax credit goes dollar for dollar against your income taxes. So this could actually provide a larger refund for people than they even paid it in taxes. And then a first-time home buyer credit up to $15,000. So really here, the biggest impact that could happen is if you're making more than $400,000. And kind of a reminder is that that is looked at in the year that you have that. So if you have a big event happen where you sell a piece of real estate, you sell your business, your income could spike over $400,000 when it normally is below that amount just by a one-time event. And things could kick in here, and we'll talk about on the next slide, even with capital gain rates, that could push you into a much higher tax bracket and you can lose some deductions. You can see on Trump's position, not a lot changes. Like everything that he has kind of in place, he wants to keep in place, and a lot of those are supposed to sunset in 2025. He wants to pass something that basically makes them permanent, and also talks about replacing the tax rates for more middle income taxpayers. So not a lot changes on Trump's end. He just tries to make things permanent of what he got passed in 2018.
So we have had another question come in.
Okay.
If I can defer income into 2021, should I?
Well, that's a good question. Well, premise that I already said, we don't know what's going to happen in 2021, but so I would start with the premise of, let's assume that nothing changes. You need to look at it then first. So if nothing changes right now, you need to look at your tax rates, your overall income for 2020. And some people's income is down, especially if you own a business because of the pandemic. And so you may actually be in an overall lower tax bracket in 2020 than you would be in 2021, even though, even if you had, I don't know, if there's no tax rate changes. So assume there's no tax rate changes, but because your overall income from maybe a business has been down in 2020, we might say you need to go ahead, be safe, go ahead and pick it up in 2020 because it's not going to bump you up into that bigger tax bracket, especially if you thought your income was going to be up in 2021 and there's a possibility that you're going to go over that $400,000. Now that makes it even harder and more of a risk. So that's why when we talked about what do, you talk now. You have to kind of sit down now and look at what your tax brackets are. And even for people, we've looked at even things, what making decisions. We're going to talk about how the required minimum distribution you don't have to take. But if you don't have a lot of income in 2020, maybe you want to take it so that you get the benefit of the lower tax brackets. Because I've done scenarios where even somebody that makes, let's say you make $100,000 in let's just use 19, and then $100,000 in 2020. So $200,000 between the 2 years. If you had zero in 2019 and 220 and 220 in 2020, your tax rates actually almost doubles what you would pay. So these peaks and valleys are very difficult. And I work with a lot of real estate professionals, and they get the big peaks and valleys because when they have big transactions, they'll have high income. But anytime that we can be able to get your income to be more stable between years, more equal, and not hit these peaks with these higher tax rates and these phase outs and these limitations and alternative minimum tax and all these other things, you're better off. So I didn't really answer your question because I think it's so specific to every single person individually.
Well, and just to piggyback off that, given what we know, if Biden becomes president, and which is perhaps likely at this point, we can run scenarios that say, here's your risk, is that if you're going to make over $400,000 in 2021, but you could accelerate some income in 2020, here's potentially how much more tax you might have to pay if the income tax rates become retroactive. Or is the timing of when you're going to pay the tax under the current tax rates. And it really comes down to time value of money. Are you okay potentially prepaying the tax in April when you could really wait until the following year if income tax rates don't change? So it comes down to risk is what it is, what you're willing to take on that.
So we did have a few more questions come in.
Okay.
Should I make a large charitable contribution in 2020 or 2021?
That's a good one. So remember what we talked about here with the itemized deductions is one of the proposals is to basically limit those if you're making over $400,000. So if that ever took place in 2021, you may be better off to make the deduction or to make the contribution in 2020 if you have high income, because you're going to get the full benefit of it. Because if these itemized deduction limitation goes in, potentially in 2021 or future, you're not going to get the full benefit. And one of the things that we talk about a lot with our clients is particularly those who have invested in different markets or stocks, is that you can do a donor advised fund, which can be through a local community foundation. It could also be through just a platform like Charles Schwab or Fidelity, where you donate stocks or you can donate cash. It's not the biggest advantage, but you can donate it into a donor advised fund. And then, although you can't control it, you can tell the donor advised fund when you want it to make a disbursement to a qualified charitable organization. So although you're not legally allowed to retain control, it does allow you to put maybe cash or an appreciated long-term stock into a donor advised fund to do your charitable gifting in a future year and get the deduction in 2020. Also, as a reminder, although again, we'll kind of go back to this, you don't have to make a required minimum distribution if you're over the age of 72 in 2020 under the CARES Act. But if you're going to make a charitable contribution, you should consider in any year, since it's still around, to make it directly from your IRA. All right, Suzanne, I think this is you on capital gain rates and estate tax provisions.
Okay, so let's go ahead and talk about what we're looking at here on the two proposals. So currently, the tax rate is 15% for certain income levels, and then it increases to 20%. And you also have the healthcare tax of about 3.8% on top of that. So your maximum rate could be, in effect, about a 23.8%. So Trump's position has been that to reduce the maximum rate to get rid of the 20% increase and potentially indexing it to inflation. The other item would be, and he's also proposed a tax holiday period, which I think would be very difficult because of timing, but that was one of the proposals. So Biden's position was to increase the capital gains rate from a maximum of a 23.8 to a 43.4, so almost 20%, basically saying that if you have income above $1 million, you're going to pay ordinary rates. You're not going to get any benefit of the capital gains rates on those capital gains, which, and a lot of times capital gains are one-time big transactions. And we talked about that, earlier. So that's a big timing issue. So I guess, and I've also seen, some discussion about on capital gains, even getting rid of like the qualified income, qualified dividends, that it would be taxed at ordinary rates. And I don't imagine the stock market would respond very favorable to that. So that would be interesting to see if that continues as a discussion. And then under the estate tax provisions, so right now, under the current law, if you pass away, you can have up to $11,580,000 in assets that you own at the time you passed away or have previously gifted. So when Erin talked earlier about a gift tax, that's only if you go beyond your exemption. So if somebody does $1 million gift right now, all they have to do is tell the IRS, hey, I made $1 million gift so that when I die, instead of having $11,580,000 to be able to give, to inherit to my heirs, they're only going to be able to inherit $10,580,000. There's not a current tax paid unless you go beyond those limits. So what the Biden proposal is to roll that number back from 11 million to either 3.5 million-ish or 5 million too. So I'm just going to round it to 3.5 million or 5 million. So that's how much you would be able to either gift during your lifetime or pass through your estate upon death. Now, some of those things that get included that a lot of people don't think about is life insurance. Most of the time, unless you've gone through some planning with a life insurance trust, which is a planning opportunity, your life insurance would be included. Your retirement accounts would be included. Your IRAs or 401ks, or, in addition to things that are titled in your name, obviously the value of any businesses you own, all those things get included. So one of my bigger concerns is, we could work with the 3.5 and the 5 million, and we've talked, do you do gifting now? Do you do it later? Do you try to get the appreciation out? I mean, there's a lot of strategies that can be done around that. But when you inherit something, you get, so if my father passes away, or when he passes away, because that's inevitable, right? Death and taxes, we know that. When he passes away and I inherit his house, or my siblings and I inherit his house, in case my siblings are listening, you actually, let's say my father paid $50,000 for that house, and now it's worth $250,000. Under the current tax law, when we inherit the house, our cost basis in that house is $250,000. So if we turn around and sell it tomorrow, we have no gain if we sell it for $250,000. So our cost basis is what we call gets stepped up to the fair market value at the time of inheritance. And so that's because you have this estate tax, and otherwise what could happen is, let's say that my father's house is worth $20 million, which, I wish. And so now what would happen is that when he would pass, we would have to pay inheritance tax at 40% on the difference between the 11 million and the 20 million. And then when we sold the house for 20 million, we wouldn't pay tax again. So there's no double taxation going on. And so that's why you have this step up. So in Biden's plan, his plan is to get rid of this step up. So that means that when you inherit an asset, your cost basis for determining when you sell it is the same thing as whoever you inherited it from. So in my situation, my scenario with my father having a house that he paid $50,000 for, with the siblings, we all inherit it, we sell it for $250,000. Now we have a $200,000 taxable gain. And there's a lot of issues with this, because first of all, do I have any records on what my father paid for this house? Probably not. How long has he owned it? I mean, who knows? I mean, to try to go back, and I ask people, at least now when somebody says, I sold a house, I inherited it, I can say, well, let's go back and look at when you inherited it and try to figure out what the fair market value was at the time you inherited it, so we can figure out what your taxable gain is going to be, if any. In this situation, if this law changes, then you would actually have to go back and try to figure out what the person that you inherited it from paid for it, which is the rules if you gift right now. I just want to say that if you receive something in a gift, so my father says, I don't want to have you guys have to deal with this after I pass. I'm going to give it to you now. I'm going to put your title, your name on the deed, all the kids now. Well, because I'm a CPA, I'm like, no, Dad, don't do that, because I know that under the current law, if he does that and he gifts it to me while he's alive, my cost basis is going to be $50,000. Versus if he waits and I inherit it, because he is 92 years old and he's not going to live forever, then I know that I'm going to receive the fair market value under the current law. So those are very important distinctions. We see it happen a lot where people change title on things before they die because they want to make it easier for their heirs, but they're not getting a step up to the fair market value.
Yeah, and this is huge, Suzanne, because this, people think of the estate tax as only affecting the really wealthy. And if they eliminate the step up basis on estate assets, this affects everybody who has any sort of inheritance. And really, honestly, it would be on real estate. I mean, if you inherit cash, it's not going to affect you. A lot of times, if they're not inheriting a retirement account, it doesn't affect that as well. But this is a big one.
Yeah, it really is, and it really got I think us geeks that get up at 6 in the morning and start reading the latest on the tax laws and trying to figure out what's going on. And I'll tell you, for Halloween, I actually dressed up with it like as an angel with devil ears, because I said, the devil's in the details on this stuff. And this will be pretty significant to anybody inheriting. And I can tell you, I don't know how many times a week we get these calls from people, oh, I just inherited this, what's my tax consequence? And right now I'm able to say, is you get it at fair market value, or if it's cash, there's no tax, or if it's an IRA account, there is a pretty big impact if you receive an IRA, and especially, there's some law changes on that. So this is a big area that you need to understand what the impact's going to be to you if you inherit, or what it is to your heirs when you pass. So when we talked about that planning and just understanding what your situation is, this is why.
So Suzanne and Erin, we did have a really good question come in on this topic. Do I need to do something with my estate before the end of 2020?
Crystal ball.
Crystal ball.
I think on this one, you should be meeting with your estate attorney or talking to your CPA, or doing both if you feel like your group of assets is perhaps going to exceed that $3.5 million or $5.2 million. Because as it stands now, if you gift away the $11,580,000 and the current estate tax exemption allowed in 2020, and they changed the law, currently they can't go back and retroactively make you pay tax on a prior gift. And that, I don't think we've ever seen that piece to where they said, oh, now we changed the law. When you gifted it was this, but now we're going to change it back to that piece of it. So I know a ton of attorneys who are doing a ton of work with people who have at least about the 3.5 or 5.2, or at least about the 11,580,000. Like, let's take advantage of this while we can. Let's try and do some estate planning strategies just to lock this in. And I've even heard some say, because they really felt like it would be really hard, even in a Republican-controlled Congress, Senate, and presidency with everything that's happened with the pandemic and all the acts that have passed and money that has gone out to retain this really high estate tax exemption. So I definitely think it's worth a discussion.
And Erin, I'll add another thing in the mix is that in 2 years we're going to have midterm elections.
Oh, yeah.
And so Trump saw when he got into office, the Republicans controlled the House and the Senate, and then at midterms, obviously the House, the Republicans no longer controlled. So, whether we get a reprieve, whether there's a little bit of not a reprieve, but just some stalemate or a little bit of time period that we have, we're still going to be dealing with midterms in 2 years where you could be looking at another change in either the House or the Senate, and that would change things again. So this is, and I agree with Erin, that the current $11 million is going to sunset at the end of 25. Right. And so if nothing else, over the next 4 years, we really have got to be looking at this and really to figure out what the plans need to be. And by doing things now, you can get some of that appreciation out of your estate. And so there is reason to gift now, even if you don't get this step up, but that's right, so that you get things out of the appreciation. So again, I work with a lot of real estate folks, and we look at property that we think is going to be really highly appreciated and determine how maybe we can get that out of their estate if they're going to have a taxable estate, because we know that they're going to be beyond these exemptions potentially now or in 2026 if you just take increases. And with the deficit and the money that's been spent with this pandemic and everything, I mean it's going to be hard pressed not to generate some revenues to be able to start reducing the deficit or not increasing the deficit.
Agree. Okay, so another big one is payroll and benefits. So for those who know, if you make your Social Security, you pay both Social Security and Medicare tax on any wages or self-employed income that you have. Medicare tax, which is the smaller of the two, goes on forever. So if you make $100,000 or if you make $50 million in wages, you pay Medicare tax on the full amount. However, the Social Security payroll tax, which is a larger amount, the 12.4%, gets capped every year, and the IRS gives a limit, so it's currently capped at $137,700. That's only your first amount of self-employment income or wages are capped on paying that 12.4%. They have talked about in the Biden proposal that basically once you go over $400,000, the Social Security tax kicks back in. So that person who now makes $500,000, $1 million, $2 million, however that makes, it now has an additional 12.4%, which is huge, a huge number on that piece of it. They don't have any proposed change to Medicare taxes, and they did say they wouldn't do any change in payroll taxes between $137,700 and $400. And that $137,700, I think, actually got increased for 2021 to like $143. So it's gone up. It goes up with inflation every single year. So this could affect timing of bonuses. So people may look at it and say, oh no, if I get this bonus at the end of the year and I currently have made $390 and I get a $40,000 bonus, I'm now going to pay an additional 12.4% on that because my income is going over $400,000. So it could impact more than just like wage earners. It could impact timing on that piece. They talk about kind of automatic 401k for workers without access to plans and tax credits, which are already available. So I'm assuming that they're talking about larger tax credits if you start a retirement plan. Another big thing that happened in 2018 with the tax law was that they reduced corporate, so this is C Corp tax rates, from 35% all the way down to 21%. Biden is trying to increase that back up to 28% and even talking about a minimum corporate tax for companies that make over $100 million. The big thing with this on the 28%, and goes back to what Suzanne talked about on the last slide, is remember corporations, C corporations, pay tax on their income. And then when they distribute the money to the shareholders pay tax again, right? So they pay tax on any of the cash. Well, currently, as long as they meet the qualifications, those dividends are taxed at a qualified dividend rate, which can either be 15 or 20%. So although it's already been taxed at the C Corp level at 21%, and then you pay it again, it's not a dramatic tax that you're paying between the two. If they raise the tax to 28%, on the C Corps, and then turn around and say, hey, we're going to raise the qualified dividend rate if you make above $1 million to your ordinary income tax rate at 43.4%, that just made a huge jump in taxes paid on that income. And I think although we don't have a ton of C Corps, you got to think this affects any publicly traded company that are issuing dividends. So that qualified dividend rate change and this corporate tax rate change kind of go hand in hand. One without the other might not be as bad, but it is included on that piece of it. Sorry, Trump doesn't change anything, but go ahead.
Yeah, I also wanted to add too, a lot, because we get this question a lot. Remember that in Florida, although we don't have a personal income tax, we do have a corporate income tax. So in addition to 28% or 21% now, you also pay 5.5% Florida income tax. Right. So we do get that question quite often about, and so we can go through a comparison of C Corp versus an S Corp. And a lot of people, because of some of the other benefits and the pass-through deductions that we talked about, when you add in the state corporate tax rate of 5.5, now you're at a 26.5% versus, an individual rate.
No, agree. And just to kind of a plug for anyone who does business in multiple states, that is a really hot area and has been for years, but with the Wayfair decision that was passed a couple of years ago, if you haven't looked into your sales tax provisions or your income tax provisions, please reach out to your CPA because they are a lot more far-reaching than they used to be.
Okay, and before we move forward, I'd like to launch our third and final poll. So in just a minute, you'll see that on your screen. Do you think the tax law will change in 2021? So we'll give everybody a few seconds to respond to the poll. So 74% thought yes, 26% thought no.
So there's going to be some negotiating going on in Congress, that's for sure.
For sure. All right, so let's talk a little bit about the CARES Act, because although this isn't related to necessarily who wins the election, it is an important thing that we want to bring up, that people are understanding that this came out at the end of March, beginning of April, as a response to the pandemic, and it will affect people's 2020 tax returns. So I want to make sure everybody's kind of aware of what's out there. So for those who are not self-employed or in business, the PPP loan, which I'm sure you've heard about in the news, was a big part of the CARES Act, where they allowed people to apply for what was called the Paycheck Protection Program, and allowed, if you got that loan based off of payroll that you had in a business or as self-employed, and you met certain qualifications and how you spent the money, you could get that loan forgiven. One of the big things that I think we keep trying to communicate over and over again is that the CARES Act itself said that once the PPP loan was forgiven, it was not taxable. However, the IRS came out in late May and said, although they agreed with that, under a certain code section, they were going to say any money that loan was spent on, which will be the forgiveness would be tax exempt income, those expenses are not deductible, which in turn makes the loan forgiveness taxable. So you got to kind of pretend that if you take that loan out of $100,000 and spend it all on payroll, and that payroll is something normally you would be deducting in your profit and loss, that $100,000 goes off your profit and loss, which increases your bottom line. And there's a tax impact on that. And the current IRS position is that whether or not your loan is forgiven by the end of the year in 2020 or in 2021, those expenses are not deductible in the year they're incurred. So that could mean that although your loan doesn't officially get forgiven until next year, you may have to pick up that income on the 2020 tax return. And so although I think all practitioners and people are really fighting, including Congress that originally said this was not our intention, this is the law as of today, and we want people to know kind of what the worst case scenario is you may be paying tax on those on that loan forgiveness in 2020. There's also been a lot of loan forgiveness confusion that we kind of want to tell people about. The SBA and the Department of Treasury has put out umpteen amounts of guidance, and it comes out on a weekly basis, and sometimes counteracts something that was put out 2 weeks before. But each bank is governing how they're accepting their loan forgiveness amount. So although the forms are all standards and what you have to submit, different banks are doing it different ways. Some are inviting people to apply. Some people are taking all applications. Some people haven't started. So we just want to make sure that if you're out there and you're like, hey, my bank hasn't invited me to apply to get loan forgiveness yet, and another person might say, well, I applied 2 months ago. It's not, it has to do by bank of how they're interpreting the rules and then governing them. And the second question is then, should I go ahead and apply or should I wait? Because I have until the loan term is over to apply for forgiveness. I may have to start making payments before then, but should I just wait and see if maybe something changes with this? And the answer has been, it totally depends on your situation, financial statement implications, if you want to go ahead and get the loan off your books, if you just want to sleep better at night knowing you don't have to pay that amount back. If the bank is saying, please apply, we want to get these off our books, and there's no downturn to you, the answer might be yes. But then the answer might be yes, that, hey, my loan is complicated. I want to wait and see if more guidance comes out or if they change terms or if I can apply for a different PPP loan. That's not always the bad answer either. And then the impact of the election results, really, I think regardless of who is declared the winner, we're going to see more stimulus money come out. And will it change what has governed the PPP loan before? Like I said, weekly, they are submitting more guidance. So the election results certainly could impact it, but honestly, I think it's going to happen either way. Something else is going to change. Additional stimulus money is going to come out as the pandemic doesn't seem anything close to over.
Yeah, and Erin, I just, since I was up at 6 this morning, you know, being a geek reading, I just saw that a federal judge just ruled that the SBA has to disclose. So they already disclosed anybody that received a PPP loan for more than $150,000. So there's a list out there of any business or sole proprietor that received PPP money more than $150,000. And when they disclosed it, they gave us a range. It just showed a range. You know, they were, I think, 150 to 350, 350 to $1 million, or there was some ranges. So the federal judge just ruled last night that the SBA has to disclose all loans that were given, all taxpayers, and the exact dollar amount of their loan. So we'll see if that gets appealed or not. And one of my big concerns, and just to go back about this forgiveness piece, if you got a PPP loan for $100,000, you were required to spend all $100,000 on payroll or rent, etc., to get it forgiven. Well, now, if you're in a 40% tax bracket, you only have $60,000 to be able to spend because you now have to pay taxes on the rest. Yeah. And so the reason why they wrote the law to say the income wasn't taxable was because they wanted 100% of the loan to go towards payroll and these items, you know, the other items that they listed, and not have to go to basically paying taxes. And so that's where the conflict is, whether or not we see that there was a proposal to go back and to say, no, it's not, the expenses are still deductible, but as you can imagine, that died in Congress, and like Erin, like you said, whether or not they actually do come back and change it remains to be seen.
Yeah. So, all right. So, let's talk about some other, oh, do you have a question? Sorry.
Yeah, we did have a few questions come in if we have time.
Yeah.
Or, okay. Regarding PPP loans, and I think this is the $1 million question, should I apply now or wait?
Yeah. I mean, honestly, it comes down to your, like, why you want to apply. Do you want to get the loan off your balance sheet? Do you want to get that letter in hand for forgiveness? Are you not worried about having enough costs, not reductions in FTEs, safe harbor? And is your bank allowing you to do it? I don't see a downside in applying for the loan forgiveness now. What people have told me why they haven't wanted to do it is, honestly, they're like, why hurry? And they may change the rule to just basically blanket forgive it everything, and I don't have to give any amounts or any documentation. They may say, hey, if you have a current PPP loan, we're going to extend the term under a new stimulus act to make it even longer. So I would say if you feel comfortable doing it, go for it. If your bank allows for it, there's no reason to procrastinate. And honestly, the tax impact is going to happen regardless, unless they make a big change.
And we had one other question on the economic stimulus payment. So if I received a payment and in 2020 my income is higher, do I have to pay it back?
Oh yeah, that's a good one.
I'll take that one because we actually hadn't got a chance to talk about them yet, but I know that people read these slides ahead of time. So, I want to just talk about the economic stimulus payments, because if you received one in 18 or 19, when we prepare your tax return for 2020, we're going to probably have like a big question. Did you receive the money? So we need to know whether you received the money or not, because if you didn't receive it, you actually will receive it on your 2020 tax return. So if your income in 18 and 19, for example, was too high, and you didn't receive the money, and your income is low enough in 2020 because of the pandemic, you will qualify for the credit. And so you do need to know, we will need to know, and this happened a couple of years ago when they did stimulus money. We had a, did you get the money? And I was actually surprised how many people couldn't remember whether they got the money or not. So you need to know whether you got the money. So let's say you got the money because your income in 19 was low and met the qualifications, and then in 2020 your income is high because you have a sale of something. Do you have to pay the money back? According to the IRS, frequently asked questions, the answer is no. Now, again, I don't guarantee anything until I actually see the tax form come out on that, because that's the current position, is that if you met the criteria in either 18 or 19 and received the money, and your income is too high, you wouldn't qualify in 2020, you don't pay it back. Now you may say, well, Suzanne, I just didn't get the money. I should have qualified, and my income in 2020 is too high. I think you're SOL. I don't think you're gonna be able to get the money because it's gonna be based now on your 2020. So I do think you have until, I think, November 21st, for some reason sticks in my mind, to apply for the money. So for some reason you didn't get it, and you qualify for 18 or 19, or you're not sure, you can check with us and you qualify, you can go online and apply for the money. And you would want to do that if your 2020 income is going to be too high. If your 2020 income is not going to be too high, don't worry about it, and just do it with your 2020 tax return.
Right, and I'm assuming the IRS is going to have, last time we did this, I can't remember what year it was, they had a tool where people could go in and plug in their information and find out if they got the money and how much they got. So that'll be a fun question in our organizer this year. People, did you get the money?
Right. So what are the other income tax effects? Because these were kind of really quiet that we came out with the CARES Act. Right. So we mentioned already about the required minimum distributions, also known as RMDs, that you didn't have to take it in 2020, and that you can actually, if you're, it used to be 70 and a half, and now it's 72. So that's an option. Again, I caution people about, look at your overall tax bracket for 2020 versus 2021, especially that 74% that thinks the taxes are going to go up. You may want to decide to go ahead and take it in 2020, even though take some income, even though you're not required to, just to be able to, get some income out of your retirement accounts. Loss carryback. So when we had the tax law change, that was in 2017, that was effective in 2018, got rid of being able to carry a loss back. So if you had a loss in the current year, you could not carry it back, and you could only carry it forward. The CARES Act changed that and allowed, because what they were trying to do was to get people to be able to free up some money. And so if you had a loss in 2019, you could carry it back 5 years, or you could carry it forward. And so that's new, and now you can carry it forward indefinitely. So we had conversations for people that did have losses in 2019. I had some conversations with some of my clients, what do you want to do? Because if the rates are going to be higher, and of course we were carrying it forward to 2020, but if you're in 2020, you're going to carry it forward to 21, do you want to take it back, or do you want to carry it forward? So it's not clear. And then the last item I want to talk about was payroll tax deferrals, that they, I think it was up to $4,000 in payroll, you could defer your taxes. What we don't know exactly is how that's going to be handled for self-employed, because you pay your payroll taxes with your tax return, and whether you're going to be able to defer some of that, or if they're going to change the estimates on underpayment penalties, so we're still waiting some guidance on payroll tax deferrals for the self-employed.
Yeah, and that's, again, a deferral, not a forgiveness. So you would have to repay it in 2021 or 2022. I think it's
right. Trump was proposing, I believe, to get it forgiven. I don't think that's a proposal out there anymore. Obviously, if Biden becomes president, that they're not going to defer those payroll. They're not going to forgive those payroll taxes.
Correct.
So we did have a question on the net operating loss. How do I create a net operating loss?
If you don't already have one, right? Yeah, that's a good question.
Yeah, you don't always want a net operating loss because you don't want to have lost money. But if you are in a situation because of the pandemic and you don't, the business is closed, so one of the things you can do is purchase some assets and take bonus depreciation on them before year end. Sometimes it's a method of accounting. You can elect to use a different reporting method of accounting. There were some changes in the 2017 law that allows you to write off inventory in certain circumstances. So it's very factual. We have to go through. And again, even with all this uncertainty, we may want to say, you might want to not necessarily take the deductions in 2020 and wait till 2021, instead of purchasing assets in 2020, you may want to purchase assets in 2021, assuming it's going to be higher tax brackets and you're still going to be able to write off 100%. So I think the theme here is we just, we don't, it's more about being educated to make a decision to necessarily having an answer. I mean, we're not going to give you an absolute answer because our crystal ball doesn't work, but we can educate you and make you be informed on what the choices are, and then you have to decide what your risk factor is going to be on what you think the law changes are going to be. Obviously, we're going to be monitoring it, but we're not going to have answers, unfortunately. And it's very frustrating as a professional not to have answers, but we can at least tell you these are your options.
For sure. Anything else, Stacey?
No other questions have come in.
Okay. So if you have a question and we will either respond to the Q&A or you can email us at either of these email addresses, or an easy one is info@jmco.com. And those do get monitored and forwarded to different people regarding their expertise. And we welcome you to ask any questions. And if you haven't got with your CPA yet about your year-end planning, we encourage you to do that if you're concerned about income taxes, estate taxes, any of that. And hopefully we'll know something before January of where this is going.
We hope.
Well, it's 10 o'clock and we are out of time. Erin and Suzanne, thank you so much for taking the time to walk our audience through these tax law or proposed tax law changes. And thank you all for joining us today. We hope you have a great day and enjoy your weekend. Take care.